How to make money work for you. 5 tips from Morgan Housel. We can all be connected in different ways. We might share very different interests, anxieties, and aspirations. When we hear the word money, each one of us will have a different set of thoughts and feelings. We need to understand the psychology of money in order to acknowledge our feelings about it. Being financially successful has no correlation with intelligence, math skills, or education. It's all a matter of habit and own preferences. Now that you've identified the areas you want to focus on, it's time to create some positive changes in your life. You can start by using all 3 of these things: your brain, your ideas, and your will. The relationship between your thoughts and the way you handle money will have a big impact on how financial issues are ultimately resolved. Your financial choices might have either a positive or negative impact on your life. You could get wealthy by just living responsibly. As Morgan Housel says, financial progress isn't a precise science. It's a set of soft skills, in which one's demeanor is more important than one's knowledge. Here are 5 key takeaways from the psychology of money and wealth. Takeaway number 1. Nothing's free. As with anything, everything has a price. Figuring out the cost and being willing to pay it is often the solution to money-related challenges for many people. Expenses are often unclear until you have the experience. You hear many people advising you to hold stocks for the long haul. It may sound like good advice, but when stock markets are steadily declining, it can be difficult to keep your long-term perspective. Successful investment involves some risk, just like most other important endeavors. Yet, it doesn't rely on dollars and cents as its currency. Volatility, anxiety, doubt, uncertainty, and regret are some of its traits. It's easy to ignore these things until you deal with them in the present. Say you need a new watch, and you want something that's nice enough to impress your pals and the girl you're seeing. You decide to visit the shop to look at the merchandise. You've already done your cardio, so you may either choose to buy the watch or take it and run away. Regardless of whether you are athletic or not, it's on you to select option 1. You would credit card and swipe it knowing that's a moral thing to do, and you understand that there's a cost for buying a new watch. Just like anything else, investing isn't free. Just like any other product, you'll need to pay the price. You need to make yourself believe that market change is worthwhile. You'll need to accept the risk and volatility of business as normal, otherwise you won't be able to manage it effectively. In turbulent times, it is important to be able to withstand financial losses as much as possible. If you're not able to stomach seeing your wealth drop by a considerable amount in a single week, say 20%, you may want to reconsider what you want out of investing, since that trend could continue in the future. Volatility is going to happen to all investors at some point. Think of it as the price you pay for future success. Takeaway number 2. No one's crazy. When making financial choices, each person justifies it based on the knowledge they have at that time. They have a unique mental picture of how the system will work in their mind. Humans do crazy things with their money, but nobody's crazy. The thing is, different people from different generations were raised in different environments. Their backgrounds might be quite diverse, with some parents being of high socioeconomic status and others coming from a poor background. People experience different job markets with varying motivations and have varying degrees of luck. All this leads to very different life lessons. What seems crazy to you might make total sense to me. Practically, investors would make choices about their portfolios based on the features of their objectives and the available investment opportunities. However, people do not typically act this way. Economists believe that people's long-term investment choices are influenced by events in their own generation, particularly those that occurred during the early years of adulthood. They grew up and had different perspectives on financial stability. As a result, the point of view that something is ridiculous in one group may be completely sensible in another. Not many people make financial decisions using only a spreadsheet. These people typically do it at home, while having supper together, or during business conference. Places where people may construct a self-serving narrative based on own background, worldview, ego, pride, marketing, and strange incentives. Takeaway number 3. Room for error. The only foolproof way to succeed in a world where the odds are stacked against you is to allow for some margin of error, which you may also refer to as additional safety or redundancy. In such a world, everything relating to money is able to exist. We should be embracing the idea of making mistakes. What gives you endurance might be the discrepancy between what you want to happen in the future and what is occurring today. Over time, patience creates the opportunity for compound interest to do its thing. Being ready for things to not go as planned is the most important part of your strategy. You should never bet all of your chips at once. Nobody can really count on the world being good to them at all times, so it is important to have some wiggle room for mistakes. It is important to prepare for the possibility that your plans may not work out. Some of history's most well-intentioned ideas turned terrible when overused or taken to the extreme. It's a smart idea to have some room for error because it means you know that variability, unexpectedness, and possibility are all unknowns and are always an aspect of life. The only way to get over this is by widening the gap between what you expect will happen and what may actually happen in reality. All while continuing to fight another day. There are two different ways in which we can avoid mistakes. One would be the belief that someone must have knowledge of what the future brings, as motivated by the unpleasant sentiment that comes with accepting the contrary. The other way is that you're harming yourself if you don't take steps in advance to make the future you see happen. Avoiding single points of failure is one method to protect against their harm. All things that can break, will break. This is a way of life. The days until you have a problem will be short if several factors depend on a single issue failing. That's a huge single point of failure. To put it another way, the biggest point of failure with your money is relying on your salary alone to meet current living expenses, without any savings to help you through when things get tough. Takeaway number 4, never enough. Enough is not too little. Once you realize that your thirst for more can only lead to disappointment, is the moment you say enough. A strong desire for success might be driven by the need to outperform those in the immediate social circle. It's great when we feel motivated to grow and improve, but it's important to keep in mind that the pressure to measure up to others may make us think we're never enough. Look at some stats. As you can see, an annual salary of about $500,000 is needed in order to be a member of the top 1% of earners in the United States. A highly skilled doctor, let's say, John, makes more than enough. He is wealthy. He can afford expensive cars, profitable trips, and to outsource monotonous tasks and etc. John was happy with his financial success, until he purchased a vacation home in the Hamptons and met Adam. Adam is the CEO of a major firm and earns $10 million per year. You'd think with his recent financial success, Adam would be happy. But no, he's Michael Jordan's former boyhood pal and is a multi-time All-Star in the NBA. And while Michael has a net worth of over $2 billion, Adam's annual salary of $10 million looks like pocket change in comparison. There's always a bigger fish. We humans have a serious problem of comparing our lives to other people's. Everybody has their own high barrier of what they would call achieving success in life. This is one of those conflicts that you can't find a way to solve. It's likely that the only way to win this is by accepting defeat and admit that you may have enough. Although less than others, you should not risk what you have in order to get something else, or to get more of what you have. Takeaway number 5. The seduction of pessimism. I think you would be fascinated if I gave you a list of all the reasons why the market might go down later this year. With a huge US federal debt, stimulus checks that could lead to the return of inflation, and with new types of COVID-19 appearing in other countries. If I were to instead provide evidence for why things are and will likely continue to be getting better, it would include things like the increased life expectancies of populations around the world. Renewable energies are decreasing in cost, as well as the exponential growth in computing systems. You might shrug your shoulders and think about it twice. How come the pessimists seem so clever while the optimists seem so naive? According to Daniel Kahneman, the author of Thinking Fast and Slow, losses outweigh benefits when two possibilities are weighed up in direct comparison. Survival and reproductive rates tend to be higher in organisms that prioritize risk over opportunity. We pay greater attention to pessimists not just because of evolutionary reasons, but also because setbacks are generally far more common than instances of progress. It does take time for progress to occur, but setbacks can occur overnight. Tragedies and failures often fall within relatively short time spans that make it easier for people to develop it into a convincing story. To tell an optimistic story about the future, we must consider larger time horizons. Often an issue becomes less dramatic and more vague. A lot of people find pessimists to be more fascinating than optimists. If you're one of those people and your goal is to have more balanced outlooks in the future, then this might give you a head start. As Hans Rosling would say, the world is better than you imagined. So it's not possible to succeed in the stock market without experiencing some degree of uncertainty. Envy is one of the 7 deadly sins, and is never good to have. It's a bad idea to trade what you need and have an exchange for something you don't. Points of view can be different, which can result in multiple courses of action that seem reasonable or logical. Instead of predicting disasters, prepare yourself both financially and emotionally so you are able to survive them. You should be careful about taking investment advice. Acknowledge that you're at risk of following your instinct for survival, which is more aligned with pessimism and not optimism. If you would like to watch more videos related to creating wealth, subscribe to our channel and hit the like button. Thank you for watching.